Then it's about 8:05. Why don't we start now? Because I hope Brant can join us as soon as possible. But let's start. Welcome to our webinar today. So as I said, the topic of today's webinar is the hedge fund and private equity fund, global market investment, and the evaluations and our prospects about private equity market and hedge fund under the COVID-19 environment. So I hope we have some fruitful discussion from our about 1.5 hour the webinar here. So let me introduce you, our participants from the States first. We have Michael Hines from Beachpoint Capital. Hello, Michael.
Hello, good evening.
All right, good. And we have also Samantha Levenstein from the same company, Beachpoint Capital.
Thank you for having us.
All right, you good. And we have Bill Wappler, BAMFund. Hi, Bill. Bill, we cannot hear you. It's your voice is. I'm sorry, we have time to time some technical problem.
Okay, is that better?
Yes, that's better. We can hear you now, Bill.
Okay, terrific. Well, again, this is Bill Wappler from Balyasny, and I want to thank everyone for including us as well on this webinar.
I'm sorry. Yes, Bill. Good. Thank you. And we have Mr. Kim Jun-kun from NTS. Hi, Mr. Kim.
Hi. Yep. I'm Jun Kim from National Pension Service of the Republic of Korea. Yep.
Thank you for your time. And we have Mr. Chang Dong-hun, who is CIO of Public Officers Benefit Association in Korea, POBA. Thank you, Mr. Chang. How are you?
Yeah, how are you? Good. Thank you.
Good. Thank you. And we have Jade Seo, and his Korean name is Seo Jung-do. He is a managing director of Korea Investment Management Company. Hi, Mr. Seo.
Hi, everybody. Nice to meet you.
All right. Now, let us start our first issue. We want to discuss about what's going on in the private equity and hedge fund market globally. Not only U.S. market, but the European market and Asian market. So if you can give us your view about your evaluation, your assessment of current market situation, especially linked to the COVID-19 situation. Do we have any hurdles? Do we have any difficulties? Your firm level and your fund level, do you have any impact? It could be positive impact or it could be negative impact. If it is positive impact, if you have some benefit from COVID-19, maybe, who knows, then why? Why do you so? So please give us your background and your firm and your fund and your description about the current market situation. What's going on? And who's going to be first? Can we ask, let's say, Michael Hines first? Beachpoint Capital. What is the Beachpoint Capital?
Sure, thank you. And just so I understand timing, I understood that you'd like us each to address this for maybe 10 minutes or so, and then we'll move on to the next. Is that about correct?
Yes, you have enough time.
Okay, perfect. So first off, thank you for having us, and hopefully we can shed a little light on the part of the market that we focus on.
Hello.
BeachPoint is an investment management firm with a 30-year track record. And our specialization is in credit markets, and in particular in high yield bonds and senior bank debt, and important for this cycle, in distressed debt. Our clients are almost exclusively large institutions on a global basis, much like the other capital allocators on this call. And we tend to focus on what we think of as the non-traditional part of the market, so less followed parts of the market like middle market companies. Also, in credit markets, in sub-investment grade credit markets in particular, many of those companies will face difficulties in different parts of the cycle. And so we bring a very refined legal analytical edge to our business. We're constantly looking to apply that credit and legal expertise to investment opportunities. And that's one of the ways we drive attractive value for our clientele. For our products and for the way we invest, we have both commingled funds and separately managed accounts. And I think that's particularly important in today's market environment because many of the opportunities that arise have longer term time horizons, and in my opinion are more suitable for longer term fund and investment structures than they would be for more sort of liquid hedge funds that have liquidity requirements that are maybe only appropriate for certain parts of the market. We, as I say, have a deep legal expertise and have invested across many different types of cycles. So in many respects, this cycle is similar to past ones we've seen. And in many respects, this being more of a healthcare crisis than an economic crisis, this presents some very unique challenges. You had asked us to address, where we think there are good or bad things about the environment for our business and for our clients. So I'll address those, and you'll forgive me for presenting a somewhat of a challenged view of the world, but that is our outlook. So I'm happy to share that with you. And we focus mostly on the United States and Western Europe, so I'll be less well equipped to address Asia. So I suppose for the moment, I'll limit my comments to what we see in those markets. First off, we think there's no disguising the fact that we are in a significant economic contraction and have the view that we will be for some period of time. We think there's already been millions of job losses, and many of those, in our view, will be permanent job losses for some substantial period of time. And yet, if you look at securities markets, perhaps you'd be forgiven for not, if you just looked at prices, expecting that we'd be in the type of, in many respects, contraction and crisis that we're in. So what has given rise to that divergence between the news that we read in the paper and what we see on our screens with respect to securities prices? The answer is an unprecedented amount of fiscal and monetary policy supporting securities markets. And it is our view that eventually that will need to reverse, or fundamentals will drive outcomes more than just policy decisions. Lastly, for our part of the market, and speaking in particular about the United States and Western Europe, that policy, both fiscal and monetary, have benefited very big corporations. They've benefited investment grade bond markets, but they really have not to the same extent benefited sub-investment grade bond markets. So there's a lot of the parts of our market that we focus on that have not participated in that recovery, in particular the lowest quality part of the market where we find the most opportunity. So maybe I'll touch on that a little bit later, but there's been a huge stratification in the performance of credit markets. The high grade quality, the high grade part of our markets have performed and been the beneficiaries of government support. The lower parts, not so much. And while the high yield index, one of our key benchmarks, is about break even for the year, the lowest quality parts of that market are still down 9–10%, depending on which part of the index you're looking at. So those parts of the market have substantially underperformed. So, the other part that I think is important to just appreciate as relates to credit markets is the backdrop going into this crisis. So If you were to look back to the year end of 2019, we're already looking at an environment for companies where on average, they were historically very highly leveraged. So companies had already raised record amounts of debt relative to their profitability and were the beneficiaries of historically low interest rates. And so we already saw at the year end 2019, a backdrop that could be long-term challenging if we faced an economic cycle. And now we're in one, and the result of that is what you'd expect. Defaults in the high yield market are already over $100 billion. So they have already exceeded the defaults that we saw in 2019. And we're not even already through the year, and defaults in 2021 are expected to probably meet or exceed 2020 levels. And so this is an economic impact in our markets that's going to continue to be a factor, and one that we think will create great opportunity for people, firms like ours that specialize in that particular part of the market. In particular, I'd note that there's one part of our market that has also been disproportionately not a beneficiary of policy. So the bond markets have been the beneficiaries of government support, but the loan markets, not so much. They have really not received that benefit. And so we're seeing a big stratification between bond prices and loan prices, even for sort of similar credit risks. So that's a part of the market that we're also relatively focused on. As relates to where we find value right now, we focus on the middle market and less covered companies. But despite that, we're really looking for three major things in the companies we traffic in. The first is we're looking for companies that have really strong underlying assets, and those companies will survive in some form or other, no matter how long this cycle exists. And we're also looking for companies whose credit have legal protections written into their documents that provide substantial protections. And so a huge part of our firm is focused on reading every word of every credit document to understand which bonds and loans will be more resilient to the cycle and more protective of creditors' rights. That's a huge part of the time we put forth into corporate analysis. The second is you can have companies with too much debt that maybe were the subject of buyouts and other things that left them over leveraged. But we're looking for companies that in any case already still have dominant market shares in their respective industries. These companies tend to be more resilient. They tend to have lower probability of capital impairment to their creditors. And these are companies that if they do default and we go through restructurings, we're more than happy to own on the other side of that restructuring. And that's a part of our business model. The last thing is, we find companies that have mission critical services, and likewise are companies that we think will continue to be beneficiaries in the long term of their franchises and will be resilient throughout these types of economic cycles. And we'd expect likewise for those to be companies we're happy to invest in through their credit and see that credit perform or otherwise become part of the ownership if they require restructurings. And that's a core part of the opportunity set that we see. And so, just to summarize for a moment, and then I'll pass it off. For our business, this is the type of environment we look for. We look for environments where there's going to be disruption. We look for environments where we can apply our deep sort of credit and legal analysis to underlying securities. And those have historically been opportunities for us to provide a ton of value to our clientele. We've invested across so many different types of distress cycles that at this point we've sat on over 100 different creditor and restructuring committees. So we feel very comfortable in this environment. And we're forecasting a substantial increase in our investment pace. Just as a small data point, in the month of March, we deployed more capital than we have in the history of the firm. That has since slowed down modestly since then, but we would forecast exceeding that pace in the cycle that we predict to come over the next year or two. So economically, we view it as quite negative. For Beach Point, we're quite enthusiastic about our prospects over the next several years.
Thank
So
you.
maybe now
Thank
I'll
you,
hand it
Michael.
back up to some of my
Thank you.
my peers, and thank you for giving me the chance to talk a little bit about what we do.
Thank you. Thank you too. Long story in short, you said your firm your firm is enjoying kind of benefits from this kind of environment, disruption of the market and distressed market. Can I ask you just a simple number as a number? What kind of the YTD you have in your flagship fund?
So in our flagship fund, in most of our funds and strategies, we're about flat for the year. And so I would say, sort of roughly on top of relevant indices. And that depends. Some of our funds are more focused on liquid securities, and some of them, the ones that I would argue are more attractive today, have a longer term time horizon, have drawdown capital, and so are relatively underinvested so far. And I think actually that's an important point. The investments that we have made and that we expect to make, these tend to not track public indices all that well, and they're investments we make with a view of holding them over 2, 3, 5 years. And largely we find those appropriate mostly for drawdown structures and funds with long-term time horizons. Don't really think of those too much on a monthly or a quarterly basis in terms of performance. We think of them more as what we view as a long-term return profile. And I'll give you a benchmark for that, which is over many decades, our flagship fund has been a roughly 10% net return for investors. And in this environment, for the capital that we're deploying, we would expect our returns to be substantially above that for today's opportunity set.
I see. Thank you.
Thank you.
Any comments on that? Let me say, the local speakers, Mr. Zhang and Mr. So, Mr. Kim from NPS, you can interrupt any of the discussion and ask some questions, any comments on that. I may not give you any specific Q&A session, Q&A time. So please, stop us if you have any questions. So what about Bill? What happened? What's going on in BAM fund? Can you tell us a little story, Mr. Wappler?
Terrific. Yes, thank you.
Before that, I'm sorry, Mr. Wappler, let me introduce Grant Muller. Mr. Muller,
Sure.
finally he solved the technical problem and he is now in our Zoom. So hi, Mr. Muller. Hi, Grant. Can you, we cannot hear you. It's 음소거하지 말아요.
Can you hear me?
Yes, now
okay.
I can hear you.
I'm laughing. Somehow everybody else got the good link. I didn't get the good link, but I finally did get it. I was listening by phone. Thank you very much. Should I introduce myself briefly, Sam?
Yes, please.
Okay, sure. My name is Brant Maller. I've met a number of you on my trip to Korea. I founded an investments think tank that actually Balyasny and Beach Point Capital are both members of, and Sam is on our board, and it's a great honor for us to work with you. And Sam asked me to join the call and perhaps ask a question or two myself, so I probably will.
Thank you. Okay, now it's Mr. Wappler, your turn.
Terrific. Well, thank you again for the opportunity to speak to the panel. And I welcome any questions. Please interrupt me if anyone has a question. A few words first about Balyasny Asset Management, or BAM. We were founded in 2001 in Chicago by our 3 co-founders, Dimitri Balyasny, Scott Schrader, and Taylor O'Malley, all 3 of whom are still at the fund and are still 110% full-time employees. From that humble beginning, over the last few years, we've grown into a global multi-strategy investment platform. Our current AUM is approximately $7 billion, and we have about 68 investment teams around the globe, investing predominantly in long-short equities, but also in various macro assets, whether it be commodities, interest rates, currencies, etc. I joined the fund about 5 years ago in June of 2015. My prior experience was at another fund, and before that I was at Morgan Stanley for 15 years. Most recently at Morgan Stanley, I was Associate Director of Research in New York for the U.S. Research Department. My current title here at BAM, I am Director of Research, and I work with our long-short equity teams on things such as the research process, their idea quality, team development, etc. I also run the Anthem PM program, which is a developing PM program. A few words about our recent performance. Year to date, through June 30th, our flagship fund is up 15%. In the month of June, we were up 2.5%. Asia is an important region for us. We have offices in Singapore, Hong Kong, and Tokyo. And as of June 30th, about 15% of our equity deployment was in Asia, and approximately 1% of that was in Korea. I envision those numbers will go up over time. We're currently prioritizing hiring additional investment professionals in the Asia region. In terms of your question about how COVID has impacted us, I guess the correct answer is that I think it's actually been helpful for us in two ways. So if you think about a long-short equity investor, a long-short equity investor has to work within a market-neutral framework. Our teams can have no more than 5% plus or minus net beta exposure. So what we seek our teams to do is to not take market risk or to not generate profit through P&L, but instead to generate profit through alpha, through bottoms-up, company-specific approach. So what works in that type of model is to be able to identify the relative winners from the relative losers. And the COVID crisis, as unfortunate as this may sound, it actually made who were the relative winners and who were the relative losers fairly obvious to a portfolio manager. And you could see which companies were going to benefit from the new work at home or stay at home trends, and you could see which companies would potentially be hurt by changing consumer spending patterns. And an example would be the airlines, obvious example, or the cruise lines, for example. So to know, to some extent, I do believe that our performance year to date has been helped by COVID because it made these relative winners and these relative losers fairly easy to identify. Now going forward, the question is, will this continue and how long and what's the prognosis? We could talk about that. I have some views. But the other aspect of why I believe COVID was helpful to BAM is something that's unique to us relative to our other multi-strategy platforms who are similar. So what is unique and different about Balyasny versus some of the other platforms is that we do encourage internally communications and collaboration across our teams. Some of the other platforms do not encourage this. In fact, they, in some cases, prevent it. And I understand why they prevent it. They want to not have groupthink, which is a valid concern. Our choice all along, even pre-COVID though, has been to promote some communication and collaboration. We think we can manage the risk of groupthink, and we think the benefits of communication and collaboration is obvious. It can help each other. So the COVID crisis was a great example of this. We had healthcare people who were letting their colleagues know about the latest vaccine or treatments being developed. We had industrial PMs who were letting their colleagues know on a real-time basis what their companies were saying about business conditions. We had consumer teams who were letting their colleagues know on a real-time basis about changing consumer spending patterns and what the data on consumer spending was showing. And in addition, we had our various macro teams who were sharing with their colleagues their views on what the government's response may be, whether it be the central banks or a fiscal program and things like that. So our internal culture of collaboration has been quite beneficial to us throughout this crisis. Why don't I stop there and see if there's any questions, or if not, I'll turn the floor over to the next speaker.
I have a question to Bill. Yeah, you said you have a relatively easy process under the COVID-19 to find out who's going to be the relatively winners and losers based on this situation. But that kind of the situation, this situation is for everybody. Every other firms have the same situation. But if as you said, you have about 15% of YTD this year, and you are enjoying this kind of environment in your equity long, short, or market neutral fund. You have certain some special ability to some competitive advantage compared to the other equity long, short.
Yeah, no, that's a very fair question. I do think, as I said, the culture of internal collaboration and communication was quite helpful. And again, that is relatively unique amongst multi-strategy platforms. The other platforms, it's not encouraged. I'll give you some examples. On January 8th, I gave a presentation to some analysts in New York, in which I highlighted this emerging new mysterious virus that was occurring in Wuhan. And myself and the group of analysts, we talked about, okay, well, if this becomes a bigger issue, what does it mean? That was on January 8th. That was definitely ahead of it being an issue, or at least recognized as an issue in the US market. We had one of our healthcare portfolio managers come to our investment committee in mid-February, and he too had done an extensive analysis of how the situation had unfolded in China and why he thought it was inevitable that the US and Europe would have a similar situation develop. Again, that was mid-February, so that was before, that was actually, the US market was on its highs at that point. So I guess we were fortunate that we saw this early and we were able to react. And because we share information across our platform, our teams were generally prepared for it. And with my comments about sorting the relative winners from the relative losers, I did say it was easy. You know, it's always easy in hindsight. At the time, it maybe wasn't as easy. So if other funds didn't see it right away, you know, I think that's understandable.
I see. So you saw that relatively faster. This kind of whistleblowing activities you have.
I think that's fair.
Early this year. Okay. So good. Any comments from our audience? Any questions?
Sam, may I ask a question?
Yes.
So, Bill, you know, it's been interesting to watch from my perspective as the hedge fund industry, which expanded dramatically, especially institutionally, sort of contracted over the last few years. So it's kind of interesting to see the firms that have withstood the test of time, right, and have managed. I'm just curious, given that we have a number of institutional CIOs here, how are you guys think, for instance, right now in this period of extreme volatility, I would think the value proposition for hedge funds would be pretty good. I'm just curious, how are you, you know, and I know that the misaligned fee structure has kind of been worked out. Performance presumably is what it is. I'm just curious how you see the role of the hedge fund in the institutional portfolio nowadays, you know, in this environment and after everything you've gone through.
So, Brent, you are asking, yeah.
Are you asking me or are you asking the panel?
No, I'm asking you, Bill. Because Aliazzi is a multi-strat that sort of made it through a very rough period for everybody.
Yeah, I mean, I think, many of the panelists, I believe, could answer this question as well. So I encourage them to jump in. My own view is that, you know, the days of a hedge fund where, you know, essentially what their business proposition that they offer to investors is a levered beta product, you know, that day has ended, probably ended a while ago, but it's clearly over at this point. I think, you know, if you are a hedge fund that can offer a product that has an attractive return stream that is predominantly or almost exclusively alpha, there is still a home for that in most portfolios. And certainly when we speak to our investors or potential investors, that is how they look at us. You know, they want to see, you know, what is the volatility of the return stream? Low is good, high is bad. They want to see what the correlation is to the S&P. And again, low is good, high is bad. And they want to see what percentage of that return is alpha and what is the quality of that return. Does it look like it's something that is repeatable and is scalable? So it's not necessarily easy to generate a return stream that fits all of these criteria. But if you can do it, I believe firmly there is still room for that in most institutional portfolios.
And just, I know you're structured as multi-strat, so I guess my other question would be, is that a benefit? Has it worked out to be a benefit?
I believe it has been. The multi-strat, where you have, some people who are experts in macro, some people who are experts in commodity, obviously a lot of people who are experts in long-short equity. They can all help each other at times. And if you have an internal culture that promotes the sharing of information, it absolutely is helpful.
Thank you.
Mr. Chang, do you have any comments on this market? What Michael and Bill said under your portfolio, POBA?
Yeah, I think the hedge fund position in POBA is not that high, but in our whole portfolio, I would say it accounts for around 3% right now. So even though it is not big, but when I think about their performance during this COVID situation, I think they have the decently protected downside risk, but there are some dispersion among those each one of those fund houses in terms of their performance. So there's quite a big disparities. So I think house selection is the best the factor to take account. Yeah.
So POBA, you are now about 3%. You have 3% out of your total AUM to the global hedge fund, not domestic hedge fund.
Altogether.
Altogether. So
Yes.
are you investing domestic hedge fund as well? Hedge fund
it's about 1%, slightly more than 1%, I think. Yeah.
Do you see your hedge fund portion will be increased in the future?
I think
3% to...
Yeah, we have a plan to increase our proportion into the hedge fund spaces further, but maybe after we verify each one of those hedge fund houses performance, then I think we will have more strong conviction. Who is the really fitting into our strategy, which means they have more capacity to deliver downside protection when market dislocation comes.